Hey, welcome to the Total Bitcoin podcast show. My name is Keyvan Davani. I'm the Total Connector. I'm really looking forward to my next talk interview with Mark J. Valek from Incrementum. He's a wealth portfolio asset manager in gold and Bitcoin. You know, he's not one of those anti-Bitcoiners or one of those Peter Schiff guys. So I really respect and really appreciate his sharing his knowledge. He was on the Value of Bitcoin Symposium in Vienna on March 5th, where he gave a presentation. The video is already online, so I'm going to put those in the show notes. And I want to have his perspectives, his thoughts, his opinions, his his vision, and what does he mean with rebalancing Bitcoin and gold, because it's one of his strategies, portfolio management, asset management strategies. So there's going to be a bunch of topics we're going to talk about. Really looking forward to that. Let me know what you think afterwards. Let me know your questions, and hope you're going to love this. Without further ado, this is my interview, my talk with Mark J. Valek. Mark Valek, thank you so much for your time coming my show to the Total Bitcoin podcast show. How are you doing?
Hi, Keyvan. I'm great, thanks. How about you?
Thanks. Yeah. Under these circumstances, I wish I would have, met you in person, do this face to face, because also of the sound quality, with professional equipment. But that's the way it is. But hopefully we can make this up for next time. I really enjoyed your presentation, by the way, on March 5th at the Value of Bitcoin Symposium in Vienna.
Thank you.
A lot of succinct knowledge, and also enjoyed our panel discussion. Mark, I've been following you for quite some time, and you have a really comprehensive knowledge on both, in both areas of gold and Bitcoin. Why don't you just, for my listeners, give maybe a brief introduction? What's your background? What's your path to gold? What's your path to Bitcoin?
Yeah, happy to do that. So I have the background of being a fund manager. So I was actually pretty early on interested in finance. Studied business administration in Vienna. Always had the goal to work in the finance sector, and actually did that already during my time at the university, and found out that the most interesting part within finance, for me at least, was asset management. I had small stop at private banking. That was interesting too, but as I said, to me, more interesting than also investment banking, for instance, to me was asset management, allocation of capital. And so I landed up there in Vienna, becoming a fund manager eventually, and really enjoyed the job. Actually also was quite enthusiastic, still are, but I did have some kind of a revelation actually in the end 2000s, more or less coinciding with the financial crisis, but actually it started a little bit earlier than that already, because after I had finished the studies, I only discovered the Austrian School of Economics, which I hadn't heard about during my studies, even though ironically I was studying in Vienna. So that was really a big turning point for me personally, because I completely fell in love with this, and it was a complete eye opener for me. And I really dug into the monetary history and monetary theory, and took a lot of courses in this regard, and did some intense reading, and ended up even writing a book a little bit later on, which is available in a few languages by now. It's called Austrian School for Investors. So yeah, and with this kind of new revelation, also my worldview on the whole industry changed a little bit, because I also became aware that kind of as part of the traditional financial industry, I was kind of a beneficiary of what I think is a very unfair financial system, You know the Cantillon effect, which is basically some a severe wealth transfer which is going on, and I actually had to ask myself the question: Do I want to stay part of this traditional banking sector, or do I want to kind of change my route completely, do something else in a different sector? But then things happened. I had a good constellation of people. I found similar thinking people already. I had known them partly, and we ended up founding our own investment boutique, which is called Incrementum. So that was 7 years ago, and we want to actually apply the Austrian School of Economics within investing. So that's what we are doing basically. We are investing for clients, and having in mind that the monetary system is not sustainable as it is right now, and therefore we are trying to figure out sensible investment strategies and use this to our advantage. But also what we also do is we are very focused on the educational side. We write a report which is well read. It's called the Goldbacked Trust Report, and it's a big publication about the gold market. It's an annual publication, and it's coming up again in May 27th. So yeah, working hard already on that one. Now that's in a nutshell what I do.
That's fascinating. Yeah, you mentioned, like it's so remarkable. I hear that from so many people who studied economics. I mean, I didn't study economics. I studied law in Vienna, but it's very interesting that so many people tell me, or it's just common knowledge now that it's not a standard knowledge that you get in regards to Austrian economics. Like you don't even learn about. Let's say maybe here and there, some people tell me, they've heard of Hayek or,
right.
But that's not part of the curriculum, right?
Not at all. And that was also really, to me, fascinating within still kind of the traditional asset management scene. When I already had learned about all this, I was actually doing fund selection also. So I was managing a fund of hedge fund. And I was able to talk to very interesting people on that with this job, and I asked them a lot of times what is their framework and so on, and if they perhaps know what do they think about the Austrian school. And similar to what you just said, my experience was oftentimes they said, yes, of course I know what it is, but then if you dug a little bit deeper, you really saw that they actually have a huge knowledge about it. At least not many. Some of them do, but not many. I mean, granted, not every hedge fund manager or not every fund manager has to have this knowledge, because it depends on your strategy. I don't know, if you do some kind of a arbitrage strategy or so, it probably isn't even a huge benefit for you. But say, for instance, macro funds, I would actually have expected that these people are pretty firm in that school of thinking. And as I said, some of them are, but it's really a small minority. Although I have to say, I think this amount of people who do know this school of thought now has increased also within the financial sector. So that's, I think, a good thing. But it's strongly debated, and it's very emotional. So I had a small debate on Twitter recently with a former colleague of mine who's kind of in the traditional mindset, and it's really completely a parallel universe. So it's difficult to actually communicate with these people, because they are so convinced that the system is the only thing what is possible, and that this is actually good and everything is under control and so on. So it's from times difficult, but I think there is a big hunger out there to see a different perspective, and we are trying to deliver that.
Mm-hmm. So would it be correct to say that because maybe also of the the crisis that we have, and the quantitative easing, the inflationary or even hyperinflationary tendencies, more and more traditional-minded people are now open to the comprehension or knowledge or principles of of sound money.
I'm sure. I mean, the Austrian School did get a big boost after 2008. So that was, I think, one start of hopefully kind of a renaissance of the Austrian School. And I've also been talking within the community, and oftentimes there the thought is going around, and I think it's a very valid thought, that kind of with the next crisis this will increase again. I mean, actually, Ludwig von Mises said it's ideas that matter, and these ideas, also thanks to the internet, are spreading and can spread. And then obviously what also gave the Austrian School additional boost, I think, is the upcoming of Bitcoin at the end of the day, because Bitcoin, I think, is something very well founded in Austrian tradition. Even the ECB said in a working paper that it's probably kind of based on the ideas of Hayek. So that was quite interesting, I thought.
Mm-hmm.
So there, and that's also something I am very enthusiastic about, that through this crypto and mainly Bitcoin community, a whole new young generation is made aware of this old tradition, old school. And so, yes, I think it's growing steadily, and it will thrive if things get worse, ironically.
Yeah. Well, Mark, let's talk about gold. I want to know your thoughts, perspective. What is gold to most people? Is it a hedge? Is it a sort of a safe, what do you call it, safe haven asset? Or what is it to most people? What is it?
It is often referred to as a safe haven asset, and to some extent, I probably would agree too. But I think it's perhaps not. That shouldn't be perhaps the first thing with what one should associate gold. What I like to point out about gold, and we also give some talks and also courses about that. What I try to always deliver in these courses is one very simple point, that gold is basically the interesting thing about gold from an investment point of view is it's not an interest-bearing asset, but it is an inflation hedge in terms of it cannot be inflated. You can't. If you hold gold, you can be very certain that your gold holdings are not diluted by a central bank. That doesn't mean, though, that it basically exhibits huge correlation with the entrance of price inflation. I mean, it does to some extent, but it's oftentimes people say. Just recently, I read Goldman Sachs came out with critique on gold, saying no, it's not an inflation hedge, and they are right to some extent. If you do like a typical regression or something like that, it's probably difficult to find a very high correlation coefficient if you do some statistical analysis. But this inflation hedge only works in the longer term, and gold, the price of gold actually rises with the amount of fiat money which is permanently actually emitted into the system. So I think one should view it like that. And just to finish up the thought, which I always try to deliver, is gold is interesting and exceptional, because not and valuable also, not so much because it's so scarce. Yes, it is scarce, obviously, but there are different commodities which are way more scarce. So just from the absolute amount of gold, it's not like anything close to the scarcest commodity available, but the available amount is the most constant. So the gold which is available above ground has been hoarded since the beginning of mankind, and so it has this characteristic that it has a very high stock to flow ratio, the concept which you and your listeners probably know very, very well. So it has a very high stock, above ground stock, and a very low flow. So every year it is only inflated by 1.5% on a very constant basis. And this figure, 1.5%, doesn't change a lot regardless of the price, because mining, you can't really increase mining drastically. And even if it's say doubled, which would be really hard to achieve from a physical point of view, but even if say you could double the amount of gold which you mine in a given year, then you still would only have 3% inflation, and so you still are very you can be very sure as holder of gold that your gold will not be diluted, and that's why it's so valuable, and that's why it's also interesting as money. It's a very constant yardstick.
Mm-hmm. Let me ask you. So when you say the scarcity, when you talk about the scarcity of gold, or I would call it, I mean, I call it relative scarcity, but is it? First of all, let me ask you this first. You wrote something, or in your arguments during the presentation, somewhere or maybe it was on Twitter, you posted. You said because of the non-monetary properties of gold, it is more stable, or it can be considered more as a more stable store of value. Because there's different opinions, like should a money have. Would it be the best? I'm not sure what Austrian economists think about it, like Hayek or whatever. But does it make a difference if it has non-monetary properties too, or use cases? I'm sorry, use cases such as industrial jewelry and stuff.
Yeah, this goes to the heart of one very vivid discussion which is going on between, say, the gold camp and for instance, the Bitcoin camp. Does some money need need to have, and that's also a difficult and very problematic actually term, intrinsic value? Does it need to have some intrinsic value? I think it would be better described as utility. So what you said, does it need to have some non-monetary value or utility to be able to ascend to money? And oftentimes Mises here is referenced with his regression theorem. He said basically, well, yes, actually, historically it was like that he was referring obviously to precious metals, that commodities ascended to money, but they had to have some kind of a non-monetary value in order to become, for instance, luxurious and so on, and this in order to have a constant demand for this commodity. And the other side, mostly the Bitcoin side, says no, that's not necessarily the case. So there's a fierce debate going on, and some of the traditional Austrians, I think, very dogmatically stuck to the argument of Mises and said, well, no, Bitcoin doesn't have a non-monetary use, and therefore it can never ascend to money. I think actually personally one can consolidate actually both views. If one basically makes the argument, which is also very sound, I think, that Bitcoin has value. It doesn't have a physical properties, obviously, but it has value in it of itself, so that it can that you can actually send information to somebody else, and you can be very certain that it's not double spent and all this. So this is kind of the intrinsic value of Bitcoin, and if you take this as intrinsic value, I think you can even basically make the argument in alignment with Mises that it can ascend to money. But that's a little bit of an academic question. I try, since I'm kind of a practitioner here, more in the asset management sphere, I try not to be so dogmatic about these things, especially now. I think at this stage, Bitcoin has already proven that it has monetary characteristics, at least. And also, perhaps just to mention another Austrian here in this in this regard, Hayek actually said money should be more an adjective. So it's like kind of moneyness. You can have things which are more, have more moneyness or less moneyness, but it's not like kind of binary. And if you take this as a thought, I think that's quite a good starting point. You have things which are more money or less money or no money at all, have no monetary properties at all. So these are some thoughts, I think, which are quite interesting.
Yeah, fascinating. So Mark, let's go back to the topic of scarcity, because I've never really wrapped my head around this. So let's just go through some, some hardcore facts, that you also stated in your presentation. You said there are approximately 200,000 tons of stock of gold, right? And the flow, or what would you call the inflation rate of gold?
Yeah, I say so. Yeah, I mean it's confusing if you have the traditional inflation rate in the mind, but as an Austrian, you actually mean the monetary inflation by inflation rate. So yeah, so you can also say the growth of the stock, if that's
So you mentioned previously, you just said that it would be possible, like if we really, like if let's say the miners, the gold miners, wanted to pull all the resources together, put also energy resources, technological innovation, maybe, could they easily, or would it be really difficult to double, let's say, the production?
Extremely difficult, and you can actually also again look back to history. I mean, we had a huge gold bull market in the 2000s, where the gold price basically went from $250 to almost 2,000. So it almost went 10x within a decade, which obviously became a huge incentive to increase the gold mining activities, and it did make more initially more unprofitable mines profitable and viable, and miners and entrepreneurs started up digging gold out again where they previously stopped doing it or found new ways and so on. But even this factor 10x didn't bring them bring the gold inflation rate up significantly. In fact, it didn't bring it up at all. The thing is, you can't really start up a mine like this. So it really needs time. You need to do the exploring and so on. So that's also kind of a protection for US holder of gold, that the gold supply cannot be increased rapidly. I mean, there are always then some, in my view, more or less ridiculous arguments from gold haters. One of them is, well, we've got these asteroids coming, and within the asteroids, there's every few years some asteroid is passing Earth, and at some point of time you will be able to mine the asteroid, and there will be so many millions of tons in there, and so. But this is in my view pretty ridiculous at this point in time.
What about? I mean, let's not go into space, but what about the oceans? I mean, I've heard so many, I don't know, experts say, if we have the technological innovation, we could, dig much deeper or whatever, go into the surface of the oceans.
Yeah, this is also something I heard a lot, and also read into this topic a little bit. So it is actually a fact that in the oceans there are like sporadic elements of gold. So if you took all, if you would be able to somehow extract these tiny elements of gold within the oceans. I don't know how much gold it is. The funny thing about that is this story is actually around for more than 100 years. So actually, during the hyperinflation in Germany, there was a scammer who said, "Okay, I know how to basically get us out of this melee, and I'm able to extract the gold out of the sea. Give me a lot of money, and I will do it for you." Obviously, he wasn't able to do it. So this is it's even if you go back further, it's like alchemy. Alchemy was basically the idea to make gold from what's it called, plumbum, I think it's called, right?
Mm-hmm.
I'm not quite sure, but so you make gold out of a monetary metal, but it basically never was. Nobody succeeded with doing it. Only central banking actually was able to make kind of gold, at least let's say, money out of the currency, out of nothing, and they were actually the only ones who were achieved what alchemy failed to achieve, to increase the gold supply by gold substitutes, because that's what they're actually doing.
Right. So you mentioned central banks. In your presentation, you went into pretty much detail. how many tons the central banks have been accumulating, especially Russia and China too, or a list of of countries. Is there some truth to that? Because there's some experts saying that China actually holds much more gold than they admit. Is it just a rumor, or do they really have, I don't know, 21,000 tons of gold, or is it just a stupid rumor?
Well, what is factual is that China hasn't been very transparent in reporting the gold allocation, so gold holdings. You can see that very well by in the official data of the IMF. For instance, Russia reports on a monthly basis their gold holdings. And China also does so. I mean, I think they had to become a little bit more transparent in the past years, but still, from time to time they announce like a huge increase of their gold supply, which they couldn't have just received within the last month. It's like the doubling of the gold supply. So that's a quite a good indication that they perhaps don't actually report everything. But obviously, I can't prove it to you or to anybody that they have way more. I know these rumors, and I think it's quite realistic that they are understating their gold holdings. But I couldn't prove it to you, as I said.
Mm-hmm. What does it mean for the price of gold? Let's say, I mean, we know it's an open secret. The gold price has been and is being manipulated. Do you want to comment on that? Like, what does it mean for? I mean, could the central banks, or they even, I think, was it Bernanke or some chairman of the Federal Reserve said, well, we could just lease it, and then if the price of gold should go up, we could just lease it out or sell it or something, and then so you can dump the price. How much truth is that to that? I mean, how?
Well, also I researched into this pretty closely, and you're right. I mean, I personally, there are like different kind of different versions of this kind of conspiracy theory. Mm-hmm. There are like camps who say like that the price is complete bogus, and at one point it will explode. I don't know, 10, 20x to the upside, because they can't suppress it anymore. I don't buy this version personally. But what you said is that there is leasing going out and generally manipulation of prices. I mean, that's also to me quite realistic, because you again look at history. For instance, when Bretton Woods fell apart, before that, actually, there was this gold fixing, where the gold price was fixed with 1 ounce of gold was $35. And since the US were too loose with their monetary policy and so on, they couldn't basically hold this price. But before they admitted that they can't hold this price, they tried to keep it down. That was the London gold pool and so on. So that was going on back then. That's a fact. And in the more recent history, what you referred to, I think it was under Alan Greenspan.
Mm-hmm.
That is actually, you can read that still in the transcript. I think it was in August 1993, where the Fed transcript is also still available, that exactly this discussion was going on, because the gold price was rising again during that time, I think from $300 to $400, and signaling inflation. And they didn't like that, because they wanted to keep interest rates low, because the economy wasn't going well. So that idea came up. Why, exactly what you said, why shouldn't we lease out some gold and suppress the price? So what I can imagine is happening in times of stress, in times of financial stress. For instance, like in financial crisis 2008. Obviously, if you have a big panic and then the gold price spikes, that's not in the interest of this system. So that there is some kind of consorted actions during these times, I can imagine, but I can't imagine that you really can suppress the gold price structurally in a severe manner. So you can, I think, and that's basically not my view. I mean, that's basically, I think, also the work of people like Dimitri Speck, who wrote a book about that, the gold cartel, who also did a lot of statistical analysis, where he analyzed the intraday prices of gold. So there are quite a few there are things that point to some kind of mingling at times, but not like every day kind of, So that's a little bit my view. I think it would be naive to say no, there is zero manipulation going on, because again, what is the job of a central bank? I mean, it's price fixing of interest rates in the first place. So if, and also foreign exchange rates. So this is basically permanent interventionism, institutionalized interventionism. So why should you stop here and shouldn't also intervene in the gold price at times? That's not so far-fetched for me.
Mm-hmm. Mm-hmm. What would be a realistic price? Because there's a lot of people saying the price could easily go now to, especially during this crisis, or trillions being printed, and quantitative easing, negative rate interest policies. So all these factors playing out. Where do you see the gold price realistically? In 5 years or so?
Yeah, well, it depends. It's a moving target. It depends, as you said, on all the monetary action which already has been taken and which is going to take place still. The way I view it generally is in a fiat money system as we have it today. You have like gold on the sidelines. It's available. You can kind of put some capital, or all your capital, whatever you can put it in there. But as long as the trust basically in the system is here, it may be kind of undervalued. It doesn't have this monetary view. It's not viewed as a monetary asset, at least not by the majority of market participants. And the big upside for gold is if this view is taken again, because it potentially does gain a place in the global financial system again, because, for instance, China and Russia team up and say, okay, we start some kind of currency exchange mechanism, which is at least with the trading they doing on an international level based on gold.
So it's a partial gold standard that you talked about, right? I mean, is it realistic from your perspective, like a sort of a gold standard, like a gold-backed currency? Is that what maybe some nations are dreaming about or or planning, like
No,
to
also,
circumvent the US dollar or the SWIFT or all these mechanisms?
I think one has to distinguish. If you say gold standard, what comes to my mind? I mean, that's again also very
Mhm.
murky definition because we had all kind of different gold standards during the history of time. But if you mean currency, which is under gold as a circulating currency, definitely that's, I think, not the plan of any nation. Also not like currency which is backed by a fixed amount of gold. Why don't I think that? Because I think governments always have the tendency they want to spend. They want to be able to spend. They don't want to have any restriction for that spending, and that's why there is this kind of natural collusion or synergy between banking, let's call it banking, and the state. If the banking sector and central banking, commercial banking all together with the legal framework of the state together provides the state the tools basically to structurally be able to overspend, that's very good for the state. It doesn't even matter if you have like a totalitarian government or if you have a democratic government, because even the democratic government has the tendency to vote the people in who promise the most for nothing, basically. So that can't work, and you need to finance it, and one way to finance it is to print. So I think it's definitely not in any interest of general countries to reinstate a gold-backed currency. But what I alluded to previously was, as I said, just like on an international settlement basis, that would be already be quite perhaps on the geopolitical from a geopolitical standpoint, be very interesting for players like Russia and China. Because if you can circumvent the dollar, which they are already, they've been doing this more and more since the last 5 years or so. Then the demand for dollars structurally drops, and this basically this game, which has been going on since almost 50 years, since the end of Bretton Woods, would at the end of the day stop. So that, I think, would be potentially be a partial motivation to start increasing your hoard of gold as a sovereign nation.
Mhm. I see. Okay, let's wrap this up, Mark. I just want to ask you tie in two questions together. Like, first of all, you interact with clients. So, do you experience like more and more of your clients or the people you're interacting with that they are now shifting more of, or maybe even selling some of the gold and putting it into Bitcoin? And what is your overall assessment of this, of today's, of the situation that we are in right now, with this whole Corona pandemic and unemployment rising, and, we're probably going, from recession probably to stagflation or depression and eventually even inflation. I mean, where do you see this going? Like sort of a bigger picture in context of gold and Bitcoin.
Okay, well, question number one. In my experience, also this is like, I mean, we deal with more traditional clients, let's say, not within like the realm of the crypto / Bitcoin universe. And still today, I mean, yes, the average knowledge is a little bit increasing, and you find people also within like the asset management sector or from some wealth managers or family offices who are quite knowledgeable at times, but generally speaking, these are only like single individuals, and it's not like enough that like big institutions have any kind of majority to really allocate capital into this sector, because of a lot of different. I mean, I wrote an article on that. I think a few reasons for that. One is not, as I said, the lack of general know-how within the industry, but also, which by now could be, I think, already not the main driver anymore, but still to some extent regulatory uncertainty. A third one, I think, which is also very difficult for the general asset management community, is the high volatility. They're not used to deal with assets which have such a high volatility, and their clients aren't either. So there also with that also comes some kind of reluctancy to allocate capital into this kind of asset class. So these are a few reasons why it still, I think, is taking time. But in my experience, the smaller kind of the entity, the higher the probability of some kind of allocation towards Bitcoin. I mean, it starts typically with, I'd say, family offices / small wealth managers, because they are more flexible and more open to that idea if they happen to have people sitting in their boards who are interested into that. It perhaps will continue to go slowly into traditional asset management, but we are still, I think, a few steps away from that, and perhaps only at the very end of the chain there will be the big institutions and the big pools of capital, which are pension funds and insurance companies and so on, because these are the most bureaucratic organizations, and you need to convince the most people in there, and so yeah, you also have that I forgot to mention, but you also have this age gap. Sometimes you have, I mean, the people in charge are usually 50 plus, and I think you have like this kind of division somewhere between 40 and 50. If you're below 40, you're generally much more open to the topic. If you're older than 50, it oftentimes gets complicated. So that's also something which naturally also will basically so the younger people will get into charge more and more, but for now this is still not, we're not there yet, if you ask me.
Okay. Mm-hmm.
Second part of the question was also quite a big question. Well, assessment of the current situation, so many moving targets. I mean, I learned to become more humble, so I think nothing is certain, but what I do think is pretty obvious by now. Obviously, I mean, this is even the IMF saying this now at this point in time. We are going into a recession, into a global recession even. Question is, of course, how long will this recession last, and is it only kind of because of this shutdown and lockdown and all these severe measurements which have been taken? I'm of the opinion, well, obviously that's the trigger, but we had already a very skewed economy going into this whole thing. So I'm of the opinion that this is probably the trigger for some much longer lasting effects. What is very, I think, crucial and perhaps the most important question is, does that matter? So we have been experiencing also on a global scale, at least, an exponential increase of debt, not perhaps only public debt, but like in aggregate. And the question is, how much debt can one load up to the system? And that's a very difficult question. I mean, but I think we have the chance, or basically the misfortunate chance is here, that at least during this decade, these debt limits will be reached. These debts cannot be maintained, and even more and more debt cannot be put up to the existing debt load. And this is, I think, something that again, this crisis will perhaps that's a catalyst for this moment to come sooner than later, because the amount of debt which is now going to be piled up as a consequence of all this, that's mind-blowing. That's really mind-blowing. So a lot of people from the traditional finance industry by now have the view about that doesn't matter. Look at Japan. A lot of critics have been saying, well, Japan has so much debt, it's just not sustainable, and this is been said since 10, 20 years, and still they are doing, I wouldn't say they're doing well, but still they're coping somehow. I think Japan is a very special case, because Japan's problem started at the end of the 80s, beginning of the 90s. And it's always a question, not many people talk about that side of the equation. You have debt, and you also, as an economy, have assets. So I think Japan had and still has a hell of a lot of assets next to that, because it's a highly industrialized economy, and it definitely was in a very good starting point. So I don't think personally, for instance, that if you take the EU or the US for that matter, as that these two economies have that much capacity, because neither the EU as a whole has that much capital on to basically where you can actually put that on top of it, and also not the US. So I would say, I don't know, the limits of I mean, this is a very difficult question, but the limits of debt sustainability in the US and the EU are somewhere between 150 and 200% debt to GDP. We are not there yet, but we are increasingly getting closer. Especially, as I said, I mean, I did some rough calculations for the US. If you had, I think, 106% debt to GDP last year. If you have, like, now, you can change the numbers, but if you assume 5 or 10% recession, and if you have a debt increase of $3 trillion a year or $6 trillion a year, if you take this kind of parameters, you land somewhere between 127 and 156% debt to GDP, and that's in 1 year. So that's not, now things are moving fast, you know. So that's something I'm watching very closely, and I think a lot of people were lulled into kind of a false sense of security, or just think, okay, these debt levels can be maintained forever. The central banks just prints up the money, and there will not be no consequences, and perhaps at the end of the day the central bank cancels all the debt. I don't believe that at all. That would be kind of like if you could do that, then you would be able to basically nobody would have to work at the end of the day. You could go into debt forever, print the money, and with no consequences. It will not work like that. So
do you see, besides, I mean, because it's really frightening. I mean, when once, it's understood what kind of debt expansion, or, as you also, tweet much about it, about the debt expansion. I mean, what's the worst case scenario? I mean, are we going to see beyond bailouts, like bail-in or negative rates interest, and bail-in of deposit and REIT accounts, or like in Cyprus? It's not, I mean, it's not so many years ago. It's like 2013, 2014. I mean, are we going to see like an exponential of these cases?
Well, everything is on the table, I think. I mean, the system wants to kind of survive and perpetuate itself as long as possible. So everything will be tried. I mean, when you talk about bail-ins, yes, they said this kind of slogan in the EU bailouts are out and bail-ins are in. But on the other hand, I think from a political point of view, bailing in a large amount of the electorate isn't really doing you good. So I think they will try to avoid this as good as possible. So politically speaking, inflation is always the easiest way out, but it is no way out in reality. But it's a way to postpone the pain, perhaps for one day more and one day more. but then there comes a point of no return. It could come at least, and the more you do this trick, the more money inflation you already did to monetize debt, the more difficult it gets to actually stop it. So I still have a little bit of difficulty to really imagine that like I don't know, the European Union or the US goes in a full-blown hyperinflation. Mm-hmm. But on the other hand, if I see the trajectory, I don't. I mean, something has to give. So if there is a debt jubilee that's also came up recently more and more often, I think people don't really think this through. What does it mean? I mean, it's at the end of the day, everybody is involved, because if you say, okay, sorry guys, my debt isn't worth anything anymore, who's the holder of the debt? It's again insurance company, pensions funds, and then the public again is hit. So it's not like you can't spare them from pain.
Right. So it's not going to be painless, but what's the process then of, is it going to be gradual then suddenly, or is it going to be sort of, in phases going through? This is something which I often think about. I mean, for people, like even, people on the streets, what are they going to do? I mean, just look at the unemployment numbers in the States and the insolvency of the German banks, all these factors. if you just zoom out and look at all these factors playing out, it's pretty frightening.
Well, I mean, one scenario, also there are a lot of questions attached to this, but just I throw this to you. So one scenario could be, and that's actually, in my view at least, basically how Keynes became so influential. I mean, Keynes is often bashed by people from the Austrian scene and so on, and I'm not a huge fan of Keynes, but he had some points also, good points, from a practical point of view, insofar that he realized that that back then, in the 20s, that was the gold price of the UK was basically too low relative to the money which was going around. The UK did a big mistake after World War One. They left the classical gold standard, as did, except the US, all countries, basically, to print the money to finance the war, and they wanted to go back to the gold standard, and they did so in 1925. But they didn't account for all the additional money they had printed in the meantime, and they wanted to peg it with the same pre-war ratio, and that led to huge deflation, because if you want to peg a bigger amount of money to the same amount of gold with the same price, that doesn't work. So he, and that didn't work because he already back then had unions and so on. This would have caused deflation, and it did cause deflation. And then you need to take people nominally money away from them. And that's politically not feasible. So I think basically what he said, okay, guys, you can't take these people anything away, to inflate it. I mean, it has the same effect, but it's just not. You basically trick the people, and then you come to a sensible relationship again. And that's something on a grand scale, which also basically could happen. So, say, for instance, central banks buy a lot of gold in the anticipation of there will be a big revaluation of the gold supply, which then also as a consequence will have price inflation, but at least the debt levels relative to the nominal GDP, and that's what's important, can be feasible again and can be sustainable again. And that's where we also write a lot about in our gold report, these kind of monetary relationships. And I also said this previously in our conversation. If gold is viewed as a monetary asset again, and if these kind of relationships get relevant again, and right now it's not, it's just on the sideways here and sitting there and waiting and doing nothing, at least for the international system. But if the international system decides, okay, guys, we have to reevaluate gold, and we reevaluate it, for instance, I don't know, to say $10,000 or $7,000, something like that. Things could look much better, much more sustainable again from a debt to GDP point of view.
Mm-hmm. Got it. So Mark, before we wrap up, I just wanted to ask you a last question. I mean, as you said also in your presentation, the Bitcoin's market capitalization or market value is really a smallest fraction of gold. Gold is about 10, 11 trillion. Right. So, and Bitcoin is whatever, 150 billion. Could it be, I mean, do you think it's realistic, feasible that it reaches $1 trillion market cap, like gradually and suddenly, and then it becomes really even not even for mainstream, but especially for institutional, for family offices, ultra net rich people, or just people more interesting, and then people, and then it would just be a automatic exponential factor.
Well, I don't think that I mean, yes, market cap is relevant to some extent, of course, but I think it's not the main factor. I think the main factor, as long as Bitcoin is like gold right now on the sidelines as potential option to put some capital in there, the main factor is the volatility. Mm-hmm. And it doesn't matter if it's 10 times as big as now. If it's as volatile as now, this scares a lot of people. And that's also, I talked about this also in this talk. That's something what we, again, also from our practical side, want to solve a little bit for investors. And this message I'm trying to hammer home. It doesn't matter that it's so volatile, but you can, from an asset management point of view, you can handle that. You can handle that obviously in position sizing your position. That's nothing new, but that scares professional investors too, because they are scared of the drawdown of every single position. They can't tell their clients, we've got a position in here which has a drawdown of 70-80%. They are slaughtered by their clients. But what you can do is, and that's what we also offer in one of our strategies, what you can do is you can combine it with a less volatile asset. We take gold because we think it matches very well, and then rebalance. So you always basically sell into strengths and buy into weakness on a very systematic in a systematic way, and by that you can actually take the volatility, which is a problem for a lot of people, which is psychologically a problem because of the behavioral finance problems which comes with that oftentimes. You can take that volatility and make an advantage to yourself and buy low and sell high, and have an overall risk return characteristic of one building block in your portfolio, which you can handle and which also your clients can handle. And that's our solution. That's also, I mean, I tweet about this publicly. This is no magic formula. You can do this personally, theoretically also, pretty easily. You just have to do it. You really have to stick to this strategy. I don't know, whatever is in your risk parameter, take 10%, 25% Bitcoin and 75% something else, gold, for instance, and rebalance. If Bitcoin doubles, take the profits and put in gold, and if Bitcoin halves, put in some gold from that side. So you will always be anti-cyclical, and you will have a little bit better or significant better returns as if you wouldn't rebalance, and you will be able to stomach the overall volatility.
I see. Well, you see, I mean, the Bitcoin space, we say that the volatility is actually a feature, not a bug. And because of the monetary evolution, I mean, we are, 10, 11 years into Bitcoin, and it's, would it be fair to say that the volatility is part of the price formation, or of the, of the network effect, or the network effect is actually condition for, in order to become someday in the future, in the years to come, or maybe even decades to come, sort of someday it's going to stabilize.
I thought about this question a lot, also coming from my gold background. I think the analogy here once more is interesting. If you take gold, gold wasn't volatile until the year 1971. Why? Because it was officially the unit of account. So if I don't know, the world, or at least a part of the world, would agree that everybody make Bitcoin as unit of account, there's no volatility, because then you, by definition, measure everything in satoshis, right? So that would be the way to eliminate volatility. But the question is, how do you arrive at this point? And that's a very interesting and also difficult question. I mean, I think from the practical point of view, it will take a huge problem, a huge crisis for such a scenario to play out, which may happen. But if it doesn't play out, or for the time being, and it's not in sight yet, at least I can't see it in front of the doorstep yet, at least. One needs to treat it a little bit like gold, actually, also. But then, and this is also perhaps a very interesting point, we wrote about this in our book 2014 already, and I think till today this is very neglected or not overlooked by the community. The difference between gold and Bitcoin is gold has non-monetary utilities. So by having a non-monetary values and utilities, you have a buffer for the volatility. Why is that? Because, for instance, say the gold price rises extremely, you have the scrap gold market, and suddenly the incentive of the non-monetary gold is very high to be remonetized, basically, so some old jewelry or some old, I don't know, a piece of art or whatever is dug out somewhere and is going to be offered to the market via the scrap market. And on the other hand, jewelry, the jewelry demand, India is the biggest consumer of gold. The jewelry demand will be substituted. So there will be less gold purchased for the weddings, but more silver or other things. So you have a counter-cyclical, a very counter-cyclical mechanism built into this, and this is only possible because there's a non-monetary value, and there are actually a lot of non-monetary functions for gold. Gold is a brilliant metal. It oftentimes is overseen that the physical properties of gold would be highly better for I don't know, for electronics and so on.
Right.
They are substituted by lesser quality metals just because the monetary value for the society in general is much higher. But if everybody throws away the gold bars, the industry would suck it also up. So you have, this is kind of this buffers your volatility in the long time. Bitcoin doesn't have that. It only has the monetary demand. Mm-hmm. There are some people who claim that is an advantage. I think that could be advantage when we get to the point that we say, okay, this is now a unit of account. But until we are there, I think it will stay much more volatile than gold. And again, therefore, I think this the strategy from an investment point of view is pretty certain to work for the time being. So make the best of it and rebalance and sell high and buy low. That's my advice.
All right. Okay. Well, really enjoyed our talk, Mark. Do you have any final closing thoughts on Bitcoin? Like, where do you see Bitcoin in 10 years to come? Why Bitcoin? What would you say to a noob? Why should they, start understanding Bitcoin, buying Bitcoin?
Well, when I bought my first Bitcoins, luckily a few years ago already, I thought, well, this is a new technology, and why should and there wasn't anything else around back then yet, and I'm sure there will be something new coming up, and why should this first thing be kind of the best? Technology evolves so fast, and until today, I actually think that basically potentially the competition of some rival is the biggest risk. I think so, but I think the risks since back then actually came down significantly because it is well established, and it is also, I think this is overlooked quite often, it is not a completely static thing. I mean, it is always challenged with competition, through potential forks and so on. So it's not that it didn't evolve in any kind of or matter, but it has a very high bar to have to undergo any changes. But it is possible, and it already did happen. So I think this constant competition with other cryptocurrencies made it so robust, made it even more robust over the years. And also the fact that so many very bright and smart people are actually working on that. This is actually also it's a qualitative argument, but I think it's an important one. A lot of human capital is going into this and wants this thing to work. So that's something I think is quite likely to enhance the chances that it in 10 years will not only still be here, but it will have thrived very well from this point on.
Okay, one final question: do you think it's possible that Bitcoin in whatever time frame, 20, 30 years, could become really the standard, the store of value, medium of exchange, unit of account, settlement layer, global settlement layer, just everything? Yeah,
of course. I think it's very possible. I mean, if it's going to be the medium of exchange, well, obviously this thing is good. This scalability topic has been going on for a long time, and it's still, to my knowledge, in my view, hasn't been solved in any significant way. It doesn't have to be necessarily. I mean, I go with Saif. Basically, there could be kind of a Bitcoin standard. I thought about this also before he wrote about that already. But I think a potential scenario could be that some central bank starts buying it. I mean, it's not so. Yeah. It's not.
But once that happens, even if it's just one tiny central bank somewhere, this could just boost. I mean,
exactly.
A chain reaction, right?
Exactly. So I think that's perhaps the most realistic scenario in apart from a total Mad Max global hyperinflation scenario, which I don't see yet. At least, hopefully, we won't have to go through such a thing. But that's I think quite a possible scenario where this starts a chain reaction, and then it is basically kind of. Yeah, it's basically kind of a Bitcoin standard. I mean, it will not be. I think it will not be circulating money. I mean that I don't think. But I mean, the beauty of the thing is you can opt in very easily, and perhaps there will be some kind of hybrid system where the states still have a way to do their inflation game and so on. But it's but it definitely is a good thing that it's out there, because it's some kind of a way to opt out of this whole this whole thing.
Opt out, exactly. Sort of a breakaway civilization, as I always say. But who knows what's going to happen. So Mark, want to tell my listeners where they can find you? Any other resources, links? I'm going to put your YouTube video, by the way, your presentation into the show notes too, because it's really valuable. Anything else?
Well, for people who are on Twitter, they can follow my Twitter handle, which is Mark Valek. Company site is incrementum.li, and I mentioned the In Gold We Trust report that's available for free on ingoldwetrust.report. So you can subscribe there and you will get the report on May 27th.
Beautiful. Thank you so much, Mark. Thank you for your time, and hope to see you soon again very in the future. Okay.
Take care, Keyvan. Thanks.
Thank you. Bye, Mark. Well, what do you think about that? That was really, I think, Mark is really one of the most knowledgeable people when it comes to, gold and Bitcoin. He's not, one of those Peter Schiff guys, he's like, anti-Bitcoin, but he understands, he comprehends the potential, the real value proposition, the soundness of Bitcoin, and he understands really the full potential, the total potential of it. So yeah, let me know what you think. Let me know your questions. Any other guests I should bring on, maybe in a panel discussion, possibly even together with Mark Valek. Follow me on Twitter. Make sure follow me on Twitter. Leave me a positive review if you can, and give it a retweet it, reshare it, love it, like it, whatever you do. Thank you so much for support and for listening. My name is Keyvan Davani. I'm the Total Connector. You can find me on thetotalconnector.com. My email address is hello@thetotalconnector.com. And my other podcast website is keyvandavani.com/podcast. It's all in the show notes. Thank you again so much for listening, for your support. And I hope to hear from you soon. All right.